Let's now shift focus to what the market ahead looks like, not 1 or 2 days, but perhaps the next decadal move or view on the markets. And we've been cribbing about as to how FIIs have completely eluded us. Well, one FII definitely hasn't, with one of their largest exposures to India. Let me welcome on board Vikas Pershad, Portfolio Manager, Asia Equities M&G Investments, and with him, Deepika Mundra, Director M&G, making her debut. Hi, both of you. Good to have you in the studios. So, Vikas, clearly you guys are one of the camp who hasn't eluded India, right? You've been investing all across. But what's keeping your other peers out of India?
I think it's many issues, and it's wonderful that we, after all these years, can continue to talk about these things. It's odd that we still get the same questions. You could have asked me this 5 years ago, 10 years ago. Why are FIIs not more heavily involved in India? I think there are many reasons. I think many of them are backward looking. And if you look at the move India has had, in absolute terms relative to other markets, people think, well, maybe we can find better value elsewhere. Our view is that that is not the case. I think this is a great time to be investing in India. In fact, over the last 2 years, we have increased our allocation to India by more than any other market, except for Japan and Greater China. Those three have been large allocations for us. We see a lot of opportunities beyond the index. You were just talking about the action is outside the index. We see the same thing. The leaders of yesterday are not the leaders of today. Today's leaders probably won't be the leaders of tomorrow. There's a lot to look at in India, and so we're very excited. I think it's too much fear about valuation, and we'll come back to that, I think. Too much fear about how much things have gone up, and then too much hope that other markets will deliver better returns.
Let's talk about the construct. Now, if I look at India for next 5 years, 10 years, it stands out. I mean, India's story needs no introduction. Everybody knows that, look, this is the place you want to be in. So, because my question is that when you look at the valuation construct, investing is about buying gold at the price of silver. In India, you're buying pretty much gold at the price of gold. So where will the upside come from?
I think the upside comes through time horizon arbitrage, for one. The upside comes through doing a lot of work and having the conviction that if something goes up 20, 30, 50%, or goes up 100%, that you hold on, you don't take profits, you don't sell too early. The trick in other markets is buying too early and maybe selling too late. In India, the trick is selling too early. And we've learned that over time. If you look at our portfolio broadly, we have owned the same names for months and quarters and years now. Defense is something that was just on the air. That's something that we have exposure to despite the rally. Two-wheelers and autos, some of the PSUs, we continue to hold these because we think the prospective returns continue to be high. India might be pricey in some lenses, but it's pricey because that's where the growth is. That's where the returns are. That's where the money is. And so that's why we come back to this market again and again.
So, Deepika, where do you find value on the table right now? Looking at the run-up, which some of the pockets that Vikas just highlighted, it's already taken place. And there's so much fear and panic around the valuations, the steep run-up in the stock prices already. Where would you say for the next 5 years, you would say that, I'm still willing to pay this price?
Sure. So just to add to what Vikas is saying is to be patient and not to sell too early. So some of those sectors which we think will see some months of disruption, we would still continue to invest in those. These are the cyclical ones, right? Engineering and construction, commercial vehicles, cement. Few months of disruption does not disrupt the long-term story. On the other hand, we think where companies have good assets which can generate cash flows over a very long period of time, difficult to replace assets, so hotels, airports, REITs, so not necessarily all in the benchmark, but good assets which can see strong cash flow potential over the long term. Autos, we already mentioned, that's something where we are still bullish on. Two-wheelers more than four-wheelers. We see multiple themes playing out in that space, whether it is premiumization in terms of consumer choices, transition to electric, and the cyclical recovery, which is still pending since 2019. So these are the few spaces we think we're still bullish on, irrespective of where prices have gone up, and keeping valuations in mind as well.
When you say you like cyclicals, the reason why they're called cyclicals is because they follow a cycle, right? Yeah. There would be good time, there would be bad time, there would be great time, and there would be very bad time. Where are we in the cyclicality of cyclicals?
Sure. So one is we've already seen the very bad time, right? Almost a decade of nothing happening in a lot of the cyclical stocks. So we've already been through that pain period. We've seen 2 or 3 consecutive very strong budgets. And now suddenly we see people asking us questions. This budget is not as big as what it was last 2 years around. But still there is growth. Private sector capex has barely taken off. We haven't seen any of that. If you look at corporate leverage, it's at all-time lows, right? So companies are clearly geared to invest for the future. So that's why we think that the cyclical recovery, yes, it's partially already taken place, but there's still legs to go on that front.
Because there's a term which you used in your last interaction with Ayesha, and I shamelessly used it. Can you guess that term?
He made a show on it. He just didn't use that.
Is this
I made a show on
the
it.
class of 21, right?
Yes, actually shamelessly
I knew
made
this
a
was
show on
coming.
it.
I knew this was coming. Yeah.
No, I mean, I made a show on it.
Yeah, I saw-
We had
I saw it.
everybody who will got listed in class of 21.
Yeah.
I don't remember what was my class also. It's been 30 years now. Okay, class of 21 has done well.
Yes.
Excepting Paytm.
Even Nykaa actually.
Even Nykaa, yeah. But that category in a sense has made a comeback. Earnings are there, visibility is there. Promoters are now realizing that think profits, don't think growth.
Right.
Now that's the bet on India.
Yes.
Are you looking at that spot?
At the recent IPOs you're talking about?
I mean, I'm just talking about the class of 21.
The class of 21, yes. So I did mention that we have not much exposure, some.
Yeah.
So fortunately, that sum has done well. But largely, we still remain largely uninvested in the IPOs from that year. But I think collectively, they have demonstrated their intelligence. They've gotten better. The corporate governance is getting better. The focus on profits is getting better or more acute. And the market is rewarding them for that. I think the lessons that they have learned, either intentionally or unintentionally, will benefit the class of 24 IPOs, the class of 25 IPOs, which I think we are more excited about. India is the most active market for IPOs in the world over the last 12 to 18 months. I think that will continue. And I think they will all benefit from the lessons learned from 2021. What's interesting about those companies is we didn't have very many broken or stressed business models. It was the pricing of those IPOs. And we invest based on the prospective returns, right? We can buy a good business, but if it's at the wrong price, we'll wait. And in some cases, we waited. And over time, as a result of that conversation, I also went back and looked at all of those. And I watched every one of those episodes. And it was a reminder that you need to be looking at these again, anew.
Some of those companies have done well. I guess the realization came in that when you are in the listed market, you got to play with the rules of the listed market. When
Yes.
in private market, you got to play very differently.
Yes.
You can't confuse, and that realization has kicked in. So Deepika, whether it's two-wheelers or whether it's cyclicals or whether it's defense, you're betting on a lot of recovery in the economy.
Yes.
Some would argue and say that the deep-rooted recovery has already happened. It's no longer a V. The recovery has played out very well in all the sectors. So then why are you still betting on the recovery themes, whether it is infrastructure or whether it is cement or whether it is two-wheelers?
Sure. So each of them have different reasons. Not all of it is the same. If you had to think about construction or cement, that goes sort of hand in hand in some cases. One, India is still building, right? Whether we're seeing railways, roads, airports, any type of infrastructure, you are seeing activity over there on the ground, and you're seeing the government increasingly still allocate more money to those sectors. Secondly, like I mentioned earlier, private capex has done barely anything. We hardly have seen any signs of companies announcing very large projects. Capacity utilization in the system is well above 70%. You are going to see that take place in some form or shape or the other. It might not necessarily be identical to the previous cycle. You may not see hundreds of PPP road projects, but it will happen in other shapes and forms. So we think that will continue. In terms of two-wheelers or the recovery over there, we're still not back to 2019 volumes. You have a replacement cycle which is yet to kick in, which got depressed during the entire COVID period. Secondly, you have a lot of, you see the K-shaped recovery, right? It's playing out in multiple sectors. It will play out in some form in the two-wheelers itself. And then you have the transition to electric, which is adding to volume. So that will go through its own challenges depending on charging infrastructure, subsidies, how those pan out. So there will be ups and downs on that front. But 5 years later or 3 years later, will we see better outlook for that sector? For sure.
Because at the crux of all of this boom is going to be financials, right? And private banks forming a large chunk of that. What explains the underperformance? I mean, you could exclude ICICI Bank and select few of the names, but the larger ones.
I think the magnitude of the underperformance has surprised us a little bit year to date. Now, at the start of this year, end of last year, just like we talked about last year in February, at the start of the year, we had reduced some of our private sector holdings. We have had enough of them, the private banks, this year. We have had some exposure. It's been large enough to be a little annoying, but not large enough to be hurtful. Okay. In fact, over the last couple of weeks, we have incrementally added some private bank exposure, because if you look at it relative to the PSUs, and I think the PSUs in general across sectors are doing well for many reasons, but in the banks in particular, things do look a little distorted. So again, on our time horizon, and given that we weren't full up on the banks already to start the year, we have incrementally added some. Now, to answer your question, I think it's an issue of communication. It's an issue of liquidity in the system, but that's all known. I also think it's a direct function of all the other opportunities that we're seeing. Coming back to your point on where the action is, whether it's in the index or beyond the index, look at the breadth that the Indian market has. We touched on the IPOs, most active market for IPOs in the world last year. If you look at the listed universe in India today, you now have 6,000 listed companies, and about 1,500 have a market cap over $100 million. Now that's an arbitrary number, but it just shows you that number a year ago was 1,000 companies. Now it's 1,500. That liquidity, the breadth, the depth is only going to improve. And this is why when we were thinking, what do we want to talk about? What message do we want to leave viewers with? We wanted to say, like us, we have had cash at very low levels for the past year. We've been fully deployed in India. That has been helpful. We're thinking on the long term, not the short term. We're thinking that this is a developed market. You look at India today, on what definition is this an emerging market? One of the largest markets in the world, one of the largest economies in the world, thousands of listed companies. The quality of the conversations that we now have with companies is so different from 10, 15, 20 years ago. It's about capital allocation. It's about thoughtful growth, profitable growth. These are all hallmarks of a developed market. So we have stopped calling India an emerging market. It has emerged. How much more do you want it to emerge? Keep your cash levels low. Badho desh ke saath, right? Stay invested.
Yeah.
To say that again?
It was on my coffee mug this morning.
Rise with India.
Yeah, Rise
That's
with
what
India.
it
Yeah,
said.
that's the way it
No,
is.
and Deepika, you've been researching some of these IPOs, right? The class of 2023, and you've come up with some really bright names from what I hear. Pedigree names, is that what gives you comfort?
Pedigree, but also in terms of track record, right? It might not necessarily be a very well-known name, but something that has reasonable track record will give you more comfort at these index levels. Secondly, the way we evaluate stocks, right? Where we think that the intrinsic value is higher than what the IPO is coming at. So that's the fundamental thing to begin with. So just the company deleveraging or just the promoter looking to sort of do a benchmark valuation for the company, that's not the main criteria. Where we genuinely find that there is a gap between the intrinsic value and where the IPO is coming at is what we have participated in the class of 2023.
Right. So which six sectors, I know you can't talk stocks and you can't mention those IPOs, but which sectors are of interest within the recently listed universe?
Sure. So this would be in defense, healthcare, in the technology space. These would be the 2 or 3 spaces that we looked at last year in terms of IPOs.
Because markets, they always follow a style. There's a time when dividend investing will do well. There's a time growth does well. There's a time value does well. Last 18 months, growth's done well in India. Whether it is some of the defense cyclicals or for that matter infrastructure names, and value has made a comeback, which is PSU. It's a rarity. Why is that we are seeing a rising tide phenomenon?
I think before we look abroad, you look internally and you look at the retail interest, how the financialization of savings is happening here in India. Markets, investors, retail investors are now taking money from other sources and putting it into the market. And I think that is driving it. You have a lot of people focused on this market. You have China on one hand that has gone from being a specialist market to a generalist market, and I think it's back to being now a specialist market. India's following a different direction. We started, historically, India's been a specialist market. Yeah. You have people either based here onshore or who are from here focused on this market, but you now have people being reallocated from other markets, China in particular focused on India, and you have a broader, deeper set of companies meeting up with a broader, deeper set of investors. So I think that's it. And if you look on a long-term view, there's still a lot of value in this market. If you look not at a 1-year forward PE, but if you play that it's a snapshot, right? You play that movie forward, the PEs fall pretty quickly in India. If you look, maybe this is hindsight, but the last 15 years, best performing market in the world, would you not say that India was then the cheapest market in the world 15 years ago? Because it's the one that has risen most and converged to intrinsic value, I would say on that time horizon, India is still the cheapest market in the world, which is why we're here, and which is why we have allocated our capital so assertively to this market, and why we're canvassing the whole market for ideas, because there is a lot of value here still.
So 3 years out, let me split the next question in 3 frameworks. One is a tactical trade, which is that where you're hunting for next 18 months to 24 months. Then you got to look at 5-year themes, where you are looking at perhaps value migration. And then you're looking at 10-year plus. We're talking about decades here, which is like, okay, 10-year plus, this theme will do well. Indian middle class in 10 years will do well. Banks will do well. So if you divide your portfolio in 3 parts, less than 2 years, about 5 years and 10 year plus? How would you bracket it?
I'm glad I have an advanced degree to just picture through this matrix. But in the short term, I think it's tempting to look at the mega caps, the relative underperformance. We have at the margin increased our exposure a little bit there. But I still think whether it's 2 years, 5 years, 10 years, most of the themes will be pretty consistent. The rise of the consumer, what we thought initially was a K-shaped recovery, seems to be turning into a K-shaped economy in many sectors. Okay. So hotels, two-wheelers, cars, car dealerships, listed car dealerships, all that. You broaden out, you draw concentric circles, you find more and more opportunities. I think if you want to get more specific, packaged foods, for example. Just this month, we have spoken to a couple companies based in Andhra, packaged food dairy companies, small cap, professional management teams, very focused on profitable growth. Every city we go to, every sector we look at, you are finding companies in the $100 million to $2 billion market cap range that will just compound over time. If you look today at some of the companies that are $50 to $100 billion market caps, they were $500 million to $2 billion when I moved to Asia in 2005. That's going to happen again in India, then it'll happen again and again and again.
But isn't that worrisome that it's such a steep, evident K-shaped recovery?
It is. Well, it's worrisome on multiple levels. It's worrisome for the broader populace. It's worrisome for investors in the short to intermediate term. Because if you look back, 2009 was our first conversation like this, and we were just coming out of the GFC. There was so much uncertainty. There was uncertainty around who would be in the Prime Minister's office, May 2009. There was uncertainty around the economy, local and global, what happens to oil, what happens to interest rates. Out of that came a huge market rally. There seems to be not very much uncertainty now. We're speaking in relatively confident terms that for the next few years, India is well placed. Usually following that is what Nikunj is hinting at, right? Usually following that is a period of turbulence, subpar returns. But I think in India, the growth will offset that. And we're pretty well placed here. But if you look at some of these sectors, some of the market cap accretion that you've seen in the retail sector, in some of these PSUs, it's not, we say that we're focused on the long term, but some of this multiple inflation has been so rapid and so significant that it's time to take pause and perhaps look elsewhere.
Deepika, the centerpiece for valuation is always interest rates. Like Buffett says that they act like gravity if they go higher. I'm assuming that interest rates are not going to come down in a hurry, which is what it is evident. Inflation is going to remain elevated with a downward bias. So if interest rate curve is not going to be changing in a meaningful manner, at least in India, what will that do to forward multiples and what will that do to valuations?
So typically when we're looking at stocks, we're always looking more bottom up. Our construct is not always macro based. So when you're looking at high interest rates, we're looking at companies which have pricing power, that are able to pass on higher costs or higher cost of capital to either customers or just through the system. So that's our thought process. Also, we're not betting on interest rates coming off, and our portfolio is not constructed in that way that interest rates will come off, so X% of the portfolio will benefit from that. That's not the way we think about it.
Because you've been talking about China plus one and how you don't buy that thesis right now. Enlighten our viewers about it.
Well, I think it's broader than that. That the world is so focused on China plus one. Companies are so focused on China plus one. What they also need to focus on is one plus India. So whatever market that you are selling into, you have to consider the Indian consumer, the Indian government as a potential consumer for you. If you're looking at your supply chain, you have to consider whatever market that you're focused on as your manufacturing hub to look at India as well. 18 months ago, I confess, I was not super bulled up on this Make in India theme on the short term. When Apple said that they were going to have 10 to 12% of their manufacturing capacity in India within X number of months, I thought, okay, let's give them some time. They proved it, other companies have proved it. What is interesting is there's some news today about one of the two-wheeler companies here and a Japanese company taking a stake in the EV company, right? I was in Japan last month, 13 meetings. India came up in every single one of them. I brought it up in 2. The companies brought it up in 11. They wanted to learn from us. They're sending people here. They're making investments here. And they are probably, the Japanese companies are probably ahead of most companies around the world. But that led me to think that you really have to think about not just China plus one, but one plus India. If you're selling into a country, add India. If you're making in another country, you have to think about India now, which I've come around to. I was not a believer in a big way just a couple of years ago.
But your exposure is still larger to countries like Japan and Greater China.
Today, yes, but India's catching up. Partly organically, given how the markets are going, but also because of our capital allocation. We're making active decisions there. Now, as you know, we invest globally. I think for an investor who can invest across the region and around the world, I get it why on a 1 to 2 year view, Today, you might be slightly underweight relative to other markets that you're seeing. But in the very long-term view, it's hard to be short this market, which is why we've tried not to be. In our India dedicated funds, our cash has been low. We've been fully deployed. We're relatively nimble. The good thing is there's so many options now that are liquid enough that we can move the portfolio around if necessary. But we like the portfolio as it is.
The mainland China bullish call, is it purely valuation basis because they've been so down and out, or are you actually seeing those triggers and green shoots in China and in the economy?
So this is the right question, because people think of India as an absolute return market, but it's hard to get relative performance. People think of China as a market where you can be a relative outperformer, maybe just have some cash or you're in defensive names, but you can't generate absolute returns. What we have found is that there are absolute returns to have in China. Markets follow earnings. This is what Nikunj says all the time, right? Stocks follow earnings. And we have a lot of opportunities on the ground in China in the tech hardware space, semiconductors, factory automation, in the broader EV supply chain, in the local consumer. If you look at the recent earnings release from Starbucks, I think about at the 10 or 11 minute mark, they talk about losing some share. There's a transition going on in the market, and local companies are taking share. It's because they understand their consumer, they're incorporating technology, and they're taking the market. That's going to happen in vertical after vertical, in industry after industry. So yes, it is partly valuation, and the fact that a market has just halved in 2 years. The Hang Seng has halved in 2 years. Yeah. So then naturally, that draws our attention. But there's earnings growth there as well. And when you have what we think is earnings growth, at a time when valuations are depressed, that sets it up well for prospective returns.
I'll ask a very basic question to Deepika. I'm asking this perhaps to everybody. Markets, they follow cycle. Bull market and bear market, they coexist. Looking at your understanding of the market and the valuation, you don't think we are in any kind of a bubble, at least in India?
That's a great question and $1 million question, right? We never know when we're in a bubble, but we don't think so. So as long as, like Vikas also said, we have earnings growth, we're okay. We are not seeing multiple earning downgrades. You're seeing it in some spaces for sure, but you're not seeing it across the board. So as long as earnings growth is there, as long as we're not building sky-high estimates across every single company that we have in the portfolio and then giving them top-of-the-cycle multiples, we're still okay. So when we evaluate stock by stock, go through the entire portfolio, we still don't think we're there yet. So not a bubble.
But are there pockets which are just about reaching there, which are on your watch list?
Yeah, like we said, we have to be cautious in some of the spaces where stocks have just multiplied very rapidly in a matter of even a month or 2 months. And in those spaces, we would think that, like PSUs, for instance, we'd want to be very careful on where execution is actually panning out versus just orders coming in. We've seen this cycle in the past. It starts with news flow around CapEx cycle picking up, then the orders come, and then they come in spades. But then we need the execution to follow and the working capital to follow. So we wouldn't want to ignore those facts as in how they pan out. We'd want to be careful on that front. So I think some of these stocks which have multiplied, I think in a 2-3 month time frame, we'd be a little bit more cautious on that front.
Can I add something on that? Yeah. I think a good example is EMS. So at the start of this month, we exited our last remaining exposure for now in the EMS sector. Because this is a bet that we had made early last year, Q1, Q2 last year. Starting to get familiar with it.
What is the next bet? Let's talk about it. EMS you exited.
Yeah, well, actually, it could be EMS again. Okay. On this trip that I'm about to embark on with Deepika, we're meeting a series of EMS companies. There's a very long tail to growth there. So it could be that. Hospitals has done better than we expected, so we've taken a little bit off the private sector hospitals as well. Ask me at the end of this trip, and then I'll tell you what answers we found.
Which are the companies you're meeting? That's a hint.
To the studio. She'll book that appointment.
The auto ancillaries, two-wheelers, EMS. Even I was surprised, having looked at auto ancillaries in India for so long, the auto sector in India for so long, how deep that universe is. And when companies in Japan are asking us about acquisition targets in that space here, or collaboration opportunities here, people are looking at it. And we have not spent enough time. We have exposure, but we have not spent enough time. So I think there's a lot still to do there.
Deepika, thank you very much for joining us. I hope you enjoyed your first interaction with ET Now. Look
very much. Thank you so much.
Appreciate, sir. Do you remember our first interaction, 2010? You were different. I was different.
Yeah, I saw that video a week back.
So this is called wisdom. That's what it's called. All the cycles that we've had.
Yes.
We get to get there.
Yeah.
Experience.
It's experience. Wisdom. Yeah.
It's not stress, right?
No, it's not stress.
As long as in India, there's no stress.
No. But it was such a pleasure to be here with both of you. Thank you very much for having us.
Thank you so much.
Yeah. Thank you. All right, Gautam Dugar joins us, Head of Research